Most traders freeze or panic during market crashes. But what if those moments were actually your biggest opportunities? In this video, you'll discover how to flip fear into fortune, as our head of options trading reveals the exact strategies to capitalize on asymmetric setups when everyone else is running scared. This is where the real money is made. I'm Mike Bellafiore, co-founder of one of the top proprietary trading firms based in New York City since 2005 and now Miami as well. We've built and backed some of the best traders in the game. So watch closely, take notes, and learn directly from the team that helps serious traders reach the next level.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And it's been a very wild ride in the markets, as we all know, with the most widely followed index, the SPX index, the S&P 500, hitting bear market territory intraday on April 7th, when it dropped below 4,900 before bouncing intraday. And that rapid sell-off was accompanied by a huge spike in the VIX index, the index which measures the implied volatility embedded in the pricing of SPX options, which will always happen when a period of uncertainty and a market meltdown are taking place. And in fact, on April 4th, the VIX blew through the 40 level, an episode which has only happened a handful of times in the last 10 years. And so when an event like this happens, there's a tremendous trading opportunity that's been incredibly consistent over the last 10 years. And that's what we're going to be sharing with you in today's video. So if that sounds interesting, then you might find it very valuable to stick around so you can understand how this simple trade works. Before we get into the strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. As I said earlier, the VIX hitting the 40 level has only happened a handful of times in the last 10 years. And we're going to walk you through an excellent strategy to use under these circumstances. So let's dive in. And the first of these instances was back in August of 2015, just under 10 years ago, when serious concerns about the yuan, the Chinese currency, caused the equity markets to panic. And so on the morning of August 24th of that year, the market opened dramatically down for the fifth straight day, which in turn caused the VIX to spike over 40. And so let's suppose that on that day, we pulled up an options chain expiring about a half year later on January 25th, 2016. And we found a put option strike price right below where the market was trading at 1875. And we went ahead and sold 5 of those puts for a price of 118.40, and simultaneously we bought 5 put options 50 points lower at the 1825 strike for a price of 99.50. Well, when you do that, selling a put option higher up on an options chain and buying a put option lower down on that same options chain, when we do that, we're entering into what options traders refer to as an at-the-money put credit spread, which is one of the best ways to take advantage of the great options prices that accompany any VIX spike, especially the rare VIX spike over 40. And so let's first examine the cash flow of this trade. And so starting with those 1875 puts that we sold, remember they were sold for 118.40. But remember, each index option pays off at a rate of $100 per point that the index closes below that put strike price. So we multiply that by 100 and we sold 5 of them. So when you multiply it all together, you would have received $59,200 in cash for those puts. But then you bought those protective puts 50 points lower at 1825, and using that same kind of math, you end up paying $49,750 for those 5 puts, resulting in net positive cash flow of $9,450 when you first enter the trade. Your broker, by the way, is going to require you to have at least $15,550 in your account to enter this trade, which is the trade's worst case scenario loss, so keep that in mind. Okay, so let's take a look at the price chart on the day these put options expired, which was January 29th of the next year. And while it was a bit of a wild ride, the index closed at 1940.24 the day this put spread expired. And so let's take a look at how our trade made out, because on the day options expire, they are assigned a final value. And so we can know definitively the trade's result. And so starting with the initial cash flow of 94.50, if we look at the 5 puts we sold at 18.75, you can see that those obviously expired with no value because there's no payout on a put option that expires below where the index closes. And this one expired more than 65 points below the index's final price that day. And of course, the ones we bought below that expire worthless as well, as they're even farther below the index's price. And so since both options expire worthless, the result is we just pocket the initial cash flow of 94.50 as our trade profit, a return of 64.5% against our original risk of 15,550 on the trade. The next time the VIX exceeded 40 was several years later on February 6th, 2018, when this technical event took place involving certain securities connected to VIX futures contracts. And that resulted in an explosion of the VIX index that day when it again hit that rare 40 level intraday when the SPX index closed at 2695.14. And so let's say that we go ahead and do the exact same thing with an options chain expiring about 6 months later, selling 5 puts right below where the index is trading at 26.75 for $113.75, and again buying 5 puts 50 points lower at 26.25 for $97.95. And that produces, just as it did last time, positive cash flow in the amount of $7,900 on an amount at risk, in this case, of $17,100. And so when we move to the final day of this trade, the day the options expired on July 31st, as you can see, the index closed at 2816.29 after rallying for most of the month since the trade was initiated. And so again, if we examine the result of our trade, starting with the initial cash flow of $7,900, again, both the short and long puts expired worthless, and that cash flow initially collected just drops to the bottom line, resulting in a 46.1% return on risk in this case. Now, the next time that the VIX blew up over 40 was just as the pandemic was starting, which dates back to February 28, 2020, when the index closed at 2954.22, way down from its all-time high set just a few days earlier. And in line with that, the VIX again blew up over 40 for only the third time in 3 years. So just as in the previous two cases, we put on an at-the-money credit spread with short puts at 29.50 and long puts at 2900 on options expiring about 6 months later on August 21st, this time collecting $8,925 on $16,075 in capital required. And now moving to the day that these options expired, August 21st of the same year, you can see the index not only recovered, but actually began setting all-time high records as hope grew that the pandemic would subside and the economy was stimulated for further growth. And so on that day, the index closed at a new all-time high of 3397.16. And so turning to our options trade, it should be easy to understand why both the 2950 and 2900 puts expired worthless, being so far out of the money at that point. And so we again pocket the 89.25 of initial cash flow for a 55.5% win in this case. And so we're not going to go through each of the remaining cases in detail, but suffice it to say that this would have been a winning trade for you in each case of the VIX popping over 40 over the last 10 years. In addition to the three we've already covered, the August 24th, 2015 Chinese yuan incident, the February 6th, 2018 VIX futures blow up, the February 28th initial COVID crash, there was a kind of a follow-up VIX spike in June of 2020, which resulted in a win of 92.75, where the shorts puts were 3,000, and the index closed more than 500 points higher 6 months later. Then in August of 2024, out of the blue, there was a blow-up as a result of the unwinding of the US dollar Japanese yen carry trade, which resulted in another VIX spike on August 5th, 2024, and that resulted in the VIX spiking through the 40 level again. That put credit spread trade worked out beautifully as the index then staged a massive rally, closing over 6,000 on the day that trade expired, resulting in yet another win of $5,025. And so the total profit for just those 5 days out of the last 10 years was $40,575, which is more than twice the risk of any one of those trades, meaning you could have even lost one or maybe even two of those trades and you still would have come out ahead. And so what I'd like you to take away from today's video is that when the VIX indicator goes crazy and pushes above 40, something that happened on average every 2 years over the last 10 years, so it's pretty rare, if that happens, then you may want to consider making a responsibly sized trade that basically is directionally predicting that a bounce is coming, as it did in each of the cases we just laid out. That's not to say that this trade or any trade that we've covered on our channel won't lose. In fact, every trade I've ever covered in these videos has not only the risk of losing, but they actually lose, okay? But professional traders don't seek perfection because that's impossible. Instead, we look for what traders refer to as edge, trades that for a logical reason show a demonstrable history of profit over the years. The logic behind this trade is that with an elevated VIX, you're going to get paid much better premium for your short put options than in normal times. And that in turn means that your reward potential is much bigger, and with credit spreads, the larger your reward, the smaller your risk actually is. When you have a lopsided risk-reward situation like that with any trading system, you want to pay attention to that. Professional traders do just that, and they have playbooks full of strategies that have a solid track record based on a clear, logical edge.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.